Hey traders, today we're diving into an exciting trading strategy that will allow you potentially to take $10,000 and turn it into $2,000 in monthly income utilizing the poor man's covered call and AMD. So whether you're a beginning option trader or a seasoned trader, we've got something for you. We'll cover what is a poor man's covered call and why use AMD. We're going to show you exactly how to set up the trade on the option trading platform, how to manage it, and then we will even talk about how to mitigate your risk. So if you're ready to supercharge your option trading and generate some serious cash flow, then stick around. We're going to jump into exactly how to execute the poor man's covered call. Before we get started, go ahead and hit that like and subscribe button down below. Let's get this video to 100 likes. Also, be sure and download the free options workshop in the link below. It talks about the two main benefits of trading options over buying stocks. So what is a poor man's covered call? Well, it's a twist on the regular covered call. Instead of buying the 100 shares of stock though, you're buying one deep in the money call option as a replacement strategy for that 100 shares of stock. And then you're selling a call option in the short term against it to collect premium. Now, you might be wondering why it's called a poor man's covered call. And no, it's not an insult. Really, the reason that it's called a poor man's covered call is because it requires much less capital than buying the 100 shares of stock. If, for instance, the stock is a $50 stock, and then it would require $5,000 in order to buy 100 shares of the stock. Well, with a poor man's covered call, it might only take half or less than that. It might take $2,500 or $2,000 to buy that deep in the money call. But the advantages don't stop there. Here's why the poor man's covered call can be a game changer. Lower capital requirement. As we mentioned, you need less money to start. Higher potential returns. Your percentage gains can be much higher due to the leverage of the options. Reduced downside risk. You risk less capital if the stock price drops. And flexibility. It's easier to adjust your position or switch to a different stock. In the next section, we'll break down how to set up this strategy using AMD as our example, so stay tuned. LEAPS stands for Long-Term Equity Anticipation Securities. I know, it's a mouthful. Well, the key differences from regular options are longer expiration periods, even up to 1 to 2 years, higher premiums due to extended time value, slower initial time decay or theta, and generally lower liquidity and wider bid-ask spreads. LEAPS are crucial to the poor man's covered call strategy because they provide long-term exposure to a stock with less capital. They act as a substitute for owning 100 shares of the underlying stock. They offer leverage, amplifying potential returns, and they allow for a lower cost entry into covered call writing. By using LEAPS as the foundation of this strategy, you can potentially generate income through selling short-term calls while maintaining bullish exposure to the stock with reduced capital requirements compared to traditional covered calls. To set up a poor man's covered call with AMD, we follow these steps. We select the right LEAPS option. We choose a deep in the money LEAPS call option with a delta of 0.65 to 0.7. We look for an expiration date 6 months to a year in the future. I usually like to be around 9 months and then close or roll at 6 months due to the time decay. We choose the appropriate strike and expiration. So we select a strike price below the current stock price. And again, it's the 0.65 to 0.7 delta. And we consider the time value and intrinsic value of the option. Finally, we calculate the initial investment. And we do that by multiplying the LEAPS option by 100 shares. But it will actually just show us on the platform. Okay, guys, so here we are on the Tastytrade option trading platform. There's a link down below. Check it out. You can get some benefits going through the link. I also use Moomoo. They're both very good for trading options, and there's a link for Moomoo as well. So we punch in AMD right here in the upper left, and we make sure we're on the trade page. And then this will bring up the option chains. We're in the regular options, so you can go regular or all expirations, and this has the weekly. But right now, we're going to look at the regular for the leaps. And we're going to go out to July, 239 days to expiration, so really about 9 months. And then I'm going to look at the 0.65 delta. So right here, here's 0.66, and this is delta. Calls are on the left, and puts are on the right. So we want to look at the calls, and we want to buy, so the ask. And 0.66 delta, close to 0.65, and then we're going to click on that ask, the buy, and it's 27.55. We click on that. Now remember, so our mid price is about 27.10. If we hit review and send, we'll get filled, and it costs. Here's our buying power effect and what it costs, and this is also our max loss. It's 2,710, since one option contract controls 100 shares of stock. Now, if we go to the curve mode, we can see as the stock price increases in value, it increases just like owning the 100 shares of stock. So we hit review and send, and we can place that leaps, but we can also sell a call against it. Once we've established our leaps position, the next step is to sell the short-term call against it. Here's how we approach this. The process of selling calls: we choose weekly expirations. We sell calls with strikes above the leaps strike price. We select the right strike price, so we aim for strikes with a delta between 20 and 25. We consider the current price of AMD and the current price action. We choose a strike that provides a good balance of premium and probability of expiring worthless, and that's where I see the 20 to 25 delta. We balance the income and assignment risk. The higher strike prices offer less premium but lower assignment risk, and in turn, the lower strike prices provide more premium, but they do increase the chance of being assigned. We can always roll out though. Okay, now let's look at selling our short-term call against the leaps option that we're buying. Remember I talked about weekly options, so we go right here to the hourglass and we punch in all expirations. Again, right here, all expirations. We go to the table mode. We can close this where we've got our leaps, and let's go 8 days out. So we're going weekly, and the reason we're going weekly is so that we can collect premium every single week. Now, we typically want to go, again, we're going to sell calls against it. So here's the sell and here's the buy. We want to make about $130 per week in order to meet our $2,000 profit range. So I'm going to go right here. It's actually the 31 delta, so that gives us basically a 70% probability of profit. We're going to click on the sell to sell it, and you can see how that brought down by $136 the cost of our overall trade with the leaps and the call. So as long as we stay below this 141, and we're at 137 right now, we keep that entire $138. We keep it no matter what, but if we move up above it, then we're making money on the leaps, and this will start to lose money. But again, either way, we make money. So we hit review and send and place the trade. All right, guys, let's take a look at the monthly income profit potential. It's pretty exciting. The cost of the leaps is $2,710 minus the $130 credit received. So it's about $2,580 or $2,500 roughly. And we're going to use $10,000 so we can have 4 contracts. If we generate $130 selling the short-term weekly call option against it, with the 4 poor man's covered calls, we can sell 4 short-term calls at $130 a week times 4 is $520 per week, and times 4 weeks per month, that's $2,000 per month in income generated, guys. All right, let's take a quick look at managing our position and optimizing profits while reducing risk. Adjusting based on AMD's price movements. If AMD rises significantly, consider rolling your short call up and out to capture more upside potential. If AMD declines, you may need to roll your leaps down to a lower strike to maintain an appropriate delta and collect more premium. Rolling options to avoid assignment. We don't want to get assigned. When your short call becomes at risk of assignment, we buy it back and sell a new call at a higher strike price. And we maximize income while minimizing risk. So we aim to sell weekly calls for the optimal time decay. We balance the strike selection between income generation and allowing for potential stock appreciation. So remember, on the leaps option that we bought, as that price moves up, we make money on the leaps option as well as the short calls sold against it. So we make money two ways. And lastly, we consider rolling the leaps at around 6 months to maintain a long-term position and reduce time decay. Once we get inside 6 months, the time decay increases rapidly. So I like to go out, 9 months or a year, and then once we get down to that 6-month time frame, I look to roll back out. All right, guys, let's wrap this up. Today we talked about taking $10,000 and turning it into $2,000 per month in income, utilizing the poor man's covered call and AMD. If you're utilizing this strategy, let me know. If you're utilizing a different stock, let me know as well. Any questions that you have, comment down below. I answer everyone. Remember to hit like and subscribe. Download the free options workshop. Thanks for watching. I'll see you in the next video.